Sofina is a Belgian holding company headquartered in Brussels with office in Singapore. As part of the Bel20 Index, it is one of the 20 largest capitalization in Belgium. It is worth almost $12 billion. The company invests in several industrial sectors such as telecommunication, portfolio companies, banks and insurance, private equity, services within company, consumer goods, energy, food distribution, and various other sectors. Geographically, Sofina has investments located in Belgium, France, Luxembourg, the Netherlands, the United Kingdom, and North America. That's a little bit about Sofina, but let's take a look here on Simply Wall Street because we can learn a lot about this. So first of all, Sofina is a private equity and venture capital firm specializing in direct and fund of funds investment. So Sofina invests in several sectors, industrial sectors, as you can see here. I can see consumer goods is a pretty big chunk, and also quite a bit of telecommunication, and yeah. So they're in these sectors, and that puts Sofina in a quite a bit of a unique situation here compared to some of the other companies that I've been looking at. So something that I just want to show you guys before we move on here is this snowflake here. It's just beautiful. So here is snowflake analysis, and if you don't know what this is, you can see dividends here, value here, future, past, and health, financial health, sorry. And you can see here they're more to like the health and past side, and also they have great value, right? They haven't got that great dividends, that they don't check as many boxes here. It's important to understand that Simply Wall Street is like they put together analysts like expectations, and they make it in a digestible way so that you can like get a quick look at what this company is about and yeah, how it's going. So future growth, right? That is where it doesn't look so good. So we'll take a look at that later because there's really good reason for it. So we can see here some rewards that analysts have given this company is it's trading 40% below our estimates of its fair value, and the earnings grew by 655% over the past year. Oh my god. So there is this one risk analysis, which is that Sofina has a high level of non-cash earnings. So back to the snowflake here, you can see analysts say that it is a flawless balance sheet with solid track record. Okay, so these are apparently some of Sofina's competitors. If you're going to invest in the company, then I recommend that you look up on some of these and see if they are like really a threat for the future growth. So let's head into the first tab here, which is valuation. Sofina is 40% undervalued. You can see here, you can see the current price right here of 340 euros, and the fair value is here at 584 euros. So it's apparently 40% undervalued. Let's read a bit more about this, because something that you'll see with Sofina here is it is a little bit unique. You don't often see a company with a 3.7 times price to earnings ratio. That is just not really often that you see that. And if you're new here, you might not know what the price to earnings ratio is. Price to earnings ratio is typically used as an indicator of relative value. So basically, there's multiple factors that count into this. So earnings, it's just right now. And there's also like a future PE ratio, which is taken into account analysts' predictions of the future. And this PE ratio being so low could suggest that the company is undervalued. You can see their price to sales, and this is just like their revenue. So their revenue is pretty much the same, and that is because they have a humongous gross margin here and net profit margin. You can see it almost like it's almost 100%. So why is this? Well, it's because a normal company has expenses, but this is an investment firm that invests in other companies, industries, and they haven't got really any expenses, right? So they maybe have some salaries and stuff like that, but really it's mostly the leverage of the money that you invest in them that they use to generate more money. And that is also why, as we saw up here, they have a high level of non-cash earnings. And non-cash earnings, don't know what that is. Cash earnings, on the other hand, is like when you sell a basket of eggs, like then you get cash earnings. Or if you sell a Coca-Cola, or if you sell something, right? If you make transactions, that is cash earnings. But if you own an asset like a stock and that goes up in value, you don't get any dividends, because that dividends would be considered cash flow, right? The dividends that you get. But the amount that asset increases in value does not count as cash earnings. That is non-cash earnings, because it is capital gains. It's appreciation of your assets, and that is non-cash earnings. And this company, obviously, they don't make any money through selling anything. They invest, and then that value goes up, and then they can like sell for a higher price, right? So that is why there are non-cash earnings. We can see here, if we go down here, they're growing their profit margin. The profit margin is exceptionally high, but it is actually higher than last year. You can see last year it was that net profit margin was 91%, and now it's 98%. So yeah, they have no expenses, this company. Important to understand, like, it's not exceptional, right? Because you would expect this from another company in this sector as well. You would expect a lower PE ratio, but this is exceptionally low. You can see compared to the 12 times price to earnings like we see in the whole sector. So that makes it. So that of course makes it. If you just look. So if you only look at that metric, then this would be considered a good investment, as well as if you compare Sofina to the Belgian market, which has a PE ratio, average PE ratio of 14.9 times price to earnings, then Sofina obviously is great value. There's other factors that play into this, and if you go over here to the future growth, then it looks kind of sad, to be honest, but that is because that the past year it went up 655%, as we could see up here. Earnings grew 655%. The earnings, that is crazy. So that is obviously going to decline, and we can't see, like, can we see a graph right here of their earnings? Yeah, we can see that now this is their past performance. So they have historically grown their earnings by 40% annually, and now that is forecasted to go down for the next 1 to 3. What is that? No, they're forecasted to go down, and they don't. And Simply Wall Street don't let us know when they think that that decline is going to stop. But it's safe to say that obviously this is not sustainable, the kind of growth that we have seen the past year. So that is why it is bound to go down, and the question is just how much does it go down? Does it go down to like levels where it were before, which is kind of unlikely, because now they probably have more expertise, more like infrastructure. They have, yeah. So they probably have gotten something out of this whole experience. Definitely their financial position has been, they have got a lot more assets, both short-term and long-term, but that is also because they don't operate with debt. Normally you would see these liabilities be much higher, but you can see they haven't got anything. The debt level is just nothing. You can see 0. So they haven't got, they are debt free, and that is something that analysts likes, especially in times like these where we don't know what is going to happen. We don't know if market crashes are like in the near future. So companies without any debt is considered a good thing. So yeah, we can just see here all these ratios are looking pretty good. You can see here the return on equity, which is basically, yeah, I'll read this up. A profitability measure which shows how effectively a company's management team has used its shareholders' money to generate profit. Every time you invest money into a company, Apple, let's say you invest $1,000 into Apple, then Apple can use those $1,000, and this is their return on their equity. So if you put in $1,000, they will make a 30% return, and that is great compared to the industry here, which has 11 return on equity. So that means that they can generate results with the money that you give them. So that is a great metric to understand if it actually makes sense for you to, if they need the money basically. Return on assets, you can see also here they are extremely, they're laying at the 30. So yeah, that is also great. And you can see here the return on capital employed is around 30 also. So that is another growth metric. And what you basically have to understand is it is much higher than the industry. So all these things suggest a lot of growth, a lot of, they're really using that capital to grow. They have no debt. They are great value they're great value if you listen to the analysts, and also if you kind of look at it. Yeah, so the balance sheet is completely green. You can see here no debt. So current dividends, they have actually started to pay out a bit of dividends. How nice. So they pay out 0.87% in dividends, and what we can see here is that the dividends isn't notably high compared to the bottom 25 of what? Oh my god. Okay, so Belgium apparently has very high dividends in their market. You can see here, if you compare Sofina to the bottom 25% of dividend payers in the Belgian market, which is 1.5%, which is the bottom 25, that is actually very high, and the top 25 payers, which is 5%. So they're falling a little bit behind with their payments here, but that is expected to grow. No, or is it? Yeah, okay, so they have paid out a lot more dividends, Sofina, in the past, but they have now decided to like bump that down a lot, and now we can see a slight rise here since 2021. Something that is very important to consider when you are dealing with a company that pays out dividends is, can they actually afford to pay this dividends? And for that, you need to look at their cash flow, how much money does they make minus their expenses, and then like there's 4-5 things that they can do with this money. One is they can make acquisitions. 2 is they can pay it out through dividends, which they have decided to do. They can also reinvest it back into the company or buy back shares. And buyback shares kind of does a little bit of the same thing sometimes that dividends would do. Buying back shares, imagine that there's 10 outstanding shares, and then you own one of them. You own 10% of the company, of the outstanding shares. Then they buy back 2 of those shares, so there's now 8 shares. Now you own 12.5% of the company. That has just increased your stake in the company by 2.5%. So the fact and the same thing is kind of, you can do the same thing with this dividends. You can, if you get a 1% dividends, then you can take that dividends and you can reinvest it into your position, and that way not only does your assets appreciate, they get worth capital gains, right, as we talked about, and then also your position grows. You get more and more stocks, more and more shares as the years go by. And what we really like to see is like a combination of both, but here you can see that current payout to shareholders, right, the payout ratio is very low. So that is great, right? 3%, I've almost never seen it that low, to be honest. So no doubt about that, they would easily be able to pay out more. Like a healthy ratio here is between 30 and 50% payout ratio. So this dividends is nothing for them, and that is not a problem. So they could easily pay, like we could see that they have been doing, they could easily pay out like 3 to 5% dividends, in my opinion, right? So yeah, that is great. One thing that is with this company is that I can see here that they have a 1.1% average tenure, 1%, sorry. They have an average 1.1 year of average tenure in their whole like management team. And you can see here their CEO, which is Harold. He has 14 years of experience. But I looked into this, and I think that it is because if you look at down here, the number of employees, really, they're pretty steady. But one thing I want you to look at is the amount of employees that they have. They have only 50 employees, 60 employees, and they are actually in the Bel20 Index. I think that's pretty crazy, right? But obviously it's going to be obviously when they have, also I can see that they have expanded. They have got 5 employees, which is apparently 10% for this company. So they have expanded their employees because of the recent growth, and that also brings down the average amount of years that the employees have worked there, obviously. So that is probably some of the reason for that, but it isn't the most experienced management team that I've ever seen, to be quite honest. Ownership here, there hasn't been any trading volume for the past 12 months, insider trading, and you can see here the breakdown of institutions, general public and private companies. So you can see here who owns it: BlackRock, you've heard of that, Vanguard, and some that was pretty much all about that. Let's look at the share price now. So you can see here they have had a nice bit of growth. If we look back over first the five years, you can see here 170%, 170%, and the past year 16%. Nice. Year to date down 20%. This is the rest of the market. So if you're looking at a company like Sofina, a little bit of another investment that I'm used to, maybe you are used to making these type of investments in these private equity firms. I'm not used to it, so it's kind of new for me. But I will definitely be looking into this company. I don't know if I'll buy any, but I'll look at it, right? I have a lot of stocks that I want to buy right now. Videos are coming out on the channel, so make sure that you subscribe. But thanks to the commenter that wrote that I needed to catch up on this company. Hope Charity, my man, you're getting on camera here because you really wanted this video. Hope Charity, this is you. And well, thanks for the stock tip. Make sure to write more down in the description, right? So with that said, have a great rest of your day. Peace out.